Hello everyone, welcome to the Like a Tortoise channel. For those of you who don't know me yet, my name is Eduardo, and this is a channel geared towards stock market investing education, where we believe we are strong believers in that slow and steady wins the race eventually, and that's what we intend to do with our money, right? We always put our money where our mouth is. So I want to talk about Lululemon here. It's the only position in our portfolio that is currently in the red. So I think we are down about 25% on that company. But needless to say, that doesn't upset me at all. In fact, I haven't done yet because I already have quite a bit of shares in the company, but I will seriously consider adding more if the fundamentals continue well. Even if the fundamentals don't improve, and I don't expect them to improve before the beginning of next year, as I mentioned in the last video on Lululemon, management only expects the fundamentals, namely the growth in the United States, to speed up in over the next season. So until then, I don't expect to see meaningful changes. But if the fundamentals remain as they are, and if the stock price continues to decline, then this becomes a big of a bargain. All right, and that creates an even more attractive opportunity to increase my exposure to what I believe to be a great business. But let's talk about Lululemon and how it stacks against some of its adjacent and direct competition. All right. And that's what I intend to do. But before that, take a look at this. So, for those of you who believe this is a problem solely confined to Lululemon, I think it's important to shed some light on that because that's not accurate. Okay, you can see that Lululemon falls into this industry, which is consumer cyclicals, mainly the well, hold on a second, this is all sectors. Let's go to consumer cyclicals. They fall within the apparel retail, and you can see that the apparel retail has underperformed many other sectors substantially. Okay, so the whole industry has been struggling, and you can see that by looking at Lululemon's main competitors, namely Nike, Adidas, Puma, and so on. So all these stock prices are all down substantially from the highs, and so it's not something limited to Lululemon at all. Okay, and it's again, the reason for that is because this sector is greatly exposed to tariffs. All right, they manufacture many of the goods in places like Vietnam, Thailand, and tariffs are going to hurt their bottom line eventually. Okay, but I do believe that a lot of what we are seeing right now, a lot of this negativity, bearish sentiment, is certainly an overreaction, and I think what happens when the pendulum swings to that bearish side, eventually it will swing back to the other side, and we want to be positioned. We want to be positioned in the right manner. Okay, so one of the things that I did is I was looking. Just created an Excel sheet, as you can see right here, and in this sheet, in this table, you can see that I essentially screened for all the main competitors, and then I just put them all together. And what I'm trying to do here is to see how the fundamentals compare. All right, and it's interesting to have this perspective. It's a comparative analysis, and what it will show you can be very telling, and it is very telling because the discrepancy, the gap that separates Lululemon from its main competitors is appalling, to put it lightly. Let's see. So many of you probably already know Deckers, right? You know Crocs, Nike, Adidas is not here, but and there are other businesses. In fact, some of the main competitors, which include Alo Yoga and Worry, those are not here because they are private companies. And here, of course, these are only publicly traded companies, and that's the data that I can collect from stock research platforms like Stock Analysis, where I got this information from. But let's contrast Lulu's fundamentals with the competitors. You can see in terms of ROIs, Okay, I sorted this by Royce because Royce, in my opinion, is the most important metric of all when it comes to capital allocation, right? It tells us how efficiently management is deploying capital. And so the higher the Royce, the better. But what's interesting is that look at this. So Lulu's Royce comes in at about 27%, which is slightly below Decker's. But don't forget that Decker's is not a direct competitor. They are within the footwear and accessories industry, where Lululemon also has some exposure, as we will see later on. But they are not the apparel retail. If you compare Lululemon with Gap or even American Eagle outfitters, you can see that Royce is much superior. Yeah, even Nike. Okay, so Nike is of course the largest. They have the biggest market share, right? Followed by Adidas. But you can see that Nike, which is a well-known, well-established company, only gets a ROIs of about 9%. And Lululemon is getting 27%, which is crazy. What's more, this is not just one-off. Look at the 5-year average. All right? That's 24.83%. That's crazy. Look at Nike, about 14.77%. So Nike's profitability, Nike's ROIs has declined substantially from the 5-year average. That's a bit of a red flag, isn't it? But if you see Lululemon's ROIs has actually improved, yeah, okay, which is something that I really love to see. Likewise, ROI, return on shareholder equity, is also at 42% against a 5-year average of 35%. Also best in class, which is something that I really like, right? Look at Gape. Here you have about 28, only 3.31 and 5.72. Do you know, this tells me when you see numbers like this, you can see that the company has a moat. So they have a moat, they have something special, because even though they operate in the same or very similar industries, they are able to get much better profitability metrics, much better returns on capital, which is a recipe for long-term success. What about the gross margins? 59%. Look at Nike's. Nike has about 42%. This is going to be very important. Why do I love this? Because remember that tariffs are hurting these businesses currently. And what this means is that because Lululemon has such a high gross margin, about 60%, they are actually able to absorb those costs without passing them on to customers and still come out ahead of companies like Nike. Okay? All these companies that have lower margins are going to pass on all the costs to consumers. And that can, for example, discourage consumers from buying more of their products, even though of course there is a gap between there's a significant gap between Lululemon's pricing and that of companies like Nike, right? So Lululemon is a premium brand; it prices things more expensively. Look at the operating margin, right? So gross margin, it's much easier for a company to control its operational costs than it is to control its cost of revenue costs. All right, so and that's also another reason why I like the fact that Lululemon has about 60% gross margins, because management can control the operating costs much more effectively. And even when you account for the tariffs, you can see that Lululemon still boosts a 22.88% operating margin, very bullish. Now, bear in mind that this will come down, all right? And management already pointed in that direction. But even if this operating margin falls to about 20%, it's still well ahead of competitors, which is again what I love and what I think the market doesn't seem to realize, right? I wouldn't pay too much attention to free cash flow margin because the company has been embarking on on so the company has been investing a lot. You can see, in fact, if I go here to cash flows and trailing 12 months, you can see that capex has exploded since 2019, even though this only goes back to 2021. Why? Because the company wants to fuel its international expansion. They are opening new stores in China, in Europe, and so capex has been exploding, and that uses up a lot of the cash. But a lot of this is going to be growth capex that will bring profitability down the line. At least that's what I expect it will happen. And sure enough, if you look at comparable sales across the world, they are going up, and so are revenues, which is very, very bullish. Okay, so I wouldn't pay too much attention to that. Where is it? To that free cash flow margin. What about debt? In terms of debt, look at this balance sheet. That's crazy. So Lululemon debt to free cash flow is about 1.51. Even though they are using up a lot of their cash, they would still be able to pay off all of the debt with free cash flow within less than 2 years. Yeah. So for comparison, if you look at a company like the Gap, it will take them 7 years of current free cash flows to pay down all the debt, and even Nike, yeah, it will take them about 3 years to pay down all of the debt. Okay, and look at the interest coverage, right? It's so I would say anything above 8 is very, very good, and and that's certainly the case with Lululemon interest coverage. It means that they can easily pay the interest on the debt, okay, on the debt that they have without facing any constraints. And then if you look at the let's have a look at the earnings per share growth 5 years. So this company has grown EPS by 18% so this is the annual rate of return, right? So earnings per share have grown at about 18% per year over the last 5 years. Compare that to a company like Nike, which has only managed to grow at about 6%. Okay, that's astonishing. So these guys are not only are they profitable, but they are great capital allocators and they have a stellar track record. What about the earnings projections over the next 5 years? Even despite all the headwinds, the company is still projected to grow EPS at about 10%, right? And if you look at what analysts are forecasting for Nike, they say earnings per share are expected to grow at about 16%. But what's interesting is once you get to revenues. And why do I mean by that? I don't have it here, but if you can see, if I go here to stock and lock, if I go to insights, you can see that Lululemon has grown revenue at 9% per year. At 9% over the past year. And if I switch this to Nike, yeah, let's put here insights. You can see that Nike's revenue has declined by 9.84%. Okay, this is significant. It means that Nike's business is contracting while Lululemon's business is expanding, even against the backdrop of tariffs and the removal of the what's it called, of the de minimis, right? They are still able to grow, but even though the de minimis is going to impact the company's financials only from next year onwards, but still, even the impact of tariffs is already hurting these companies, and you can see that even against that backdrop, the company still manages to grow, to expand its business. And Nike declined by 9.84%. And if you look at another company like Adidas, yeah, which is another competitor, let's see. Okay, so you can see Nike, on the other hand, has grown revenue at about 11%. Okay, So it's not, but Nike, which is by far the largest company, has shrink. So the business is actually contracting. All right, and that is another reason why I decided to invest in Lululemon as opposed to Nike. Okay, even though according to Morningstar, Nike has a wider moat compared to Lululemon, and I think that makes sense because Nike has been around for many decades. Everybody knows Nike, so they have a very brand strength. But Lululemon's brand is not as well known, and so on that basis, it makes sense for the company to trade at at a slight discount. But we will touch upon valuation later on as well, right? So let's continue. And what else can we see? Look at the P/E ratio. In fact, this is where we start talking about valuation, and I think this is incredible because the P/E ratio of Lululemon is right now at 10.86. In other words, if you are paying 10 times its current earnings, compare that to Nike, once again, which is right here, and you can see that Nike's current PE is at 33 times. But let's compare it with other companies because we already saw that Lululemon's fundamentals are so much better, right? And let's compare it to a company like The Gap, which is also within apparel retail. And you can see that these guys trade at a slightly lower PE, 9.87. And if you look at the forward PE, they trade at a forward PE of 11.51, which is once again in line with Lulu, but their fundamentals are so much worse. And the same happens with Nike. And Nike trades at a forward PE of 44. So, I mean, yeah, does this make sense to you? Nike's business is shrinking. The past the track record is by no means as great as that of Lululemon. The growth projections going forward are not much better, and still the company trades at a ridiculous valuation, right? Still like a forward PE of 44, which is crazy. And if you look, and the same happens with the PEG ratio, right? So what about the free cash flow yield? Again, the Lululemon's is using up a lot of its cash, so I wouldn't emphasize this. But if you go to earnings yield, you can see that earnings yield sits at about 9.42%. This means if you bought the whole company today, this is what the company could give you this is how much the company could give you in net income every single year, about 9.42%, which is pretty significant, right? What else do we have? They don't pay dividends, so I wouldn't put. So this is unsuitable. But right off the bat, so after what we discussed, I summed it all up right here, and there are a few things that we definitely need to pay attention as fundamental-driven investors. Number one is superior fundamentals. Lulu's gross margin of about 60% and operating margin of 23% are well above peers, Nike and Adidas. They run 43 gross margins and 8% operating. All right. What about capital allocation? Royce at 26.8%, Roy 42%. These are exceptional metrics, miles ahead of peers like Nike, for example. Nike is decent, right? But others lag badly. Same goes for free cash flow. What about the growth track record? So revenue has compounded at 22% annual since 2019 because they turned, as I can show you right here. If I go to Lululemon once again to financials, you can see. Let's go. It's taking a while, but I have it here. So you can see that in 2019, the company generated $3.3 billion in revenue. Right now, they are generating $10.6 billion. That's a 22% CAGR, compounded annual growth rate. And all the while, earnings per share have grown at 29% per year. Nike's earnings per share, only 6%. Look at this. And this makes sense because I don't expect Nike, and in fact it's impossible, right? Because Lululemon is a much smaller company compared to Nike. remember the market cap. So if I go here, market cap. So Nike has a market cap of 107 billion, while Lululemon's market cap stands at about 19 billion. So it's a significantly smaller company. That is a much smaller company, and it makes sense given that the company is still in the early stages of international expansion. It makes sense for the company to grow faster. All right, and yeah, so that's for sure. But remember that Nike is not growing at all. In fact, their revenues are declining, which is a big red flag. So let's continue with our analysis. Exactly. So most other peers are low single digits or even negative. So on fundamentals alone, Lulu deserves to trade at a premium, not a discount. What about the valuation disconnect? So the PE, as we discussed, the 5-year average, we already talked about that. Current PE of 11 contrasts the Nike's PE of 33. And then on a PEG ratio basis, Lulu is also cheaper than Nike. So yeah, what about the market? The fact that the market is punishing Lululemon, and some of my consideration here. Well, so there are a few things to bear in mind. Number one, we have to understand that if we go back to 2019, let me show you this, okay? Because I think this will help you make sense of what we are seeing right now. Let me just refresh the page. In 2019, Lululemon was trading, and this is the problem with paying too high a price for a company, because no matter how great the company is, if you pay too high a price, what happens is, even if earnings continue to increase over time, but if the PE slowly reverts back to mean or follows slowly, you can end up with no gains at all. Okay, and that's part of what happened with Lululemon, because if we go to 2019, let me pull up the PE history. You can see that back in 2019, the company was trading at a PE of nearly 50. Okay, and in 2021, it got to as high as 72 times earnings. So yes, over the last 5 years or so, earnings have compounded at 22% per year. But price decline, the valuation, right, the multiple compressed exactly because, I mean, you had a lot of high expectations around these years. And so this brings down the multiple, and thus investors who bought Lululemon in 2019 or even in 2021 have made no gains because they pay too high a price. Okay, so that's, of course, that's part of what we are seeing right now. But there are other reasons. Number one, market narrative shift. Investors worry that Lululemon is a single product company overly reliant on yoga at leisure. Now, this is not true if you understand the business, okay? And so, for example, they are selling more, they are branching into other businesses like footwear, for example, where they're going to be competing with Nike, right, toe to toe. But still, so they are branching into other businesses to bring some diversity. But what's important in the case of Lulu is that about 70% of their revenue is still generated in the Americas, and that's where the main problem lies, because that's been a significant, especially in the United States, the sales have been decreasing substantially, right? What about competition concerns? Yes, rising traction from Alo and Vuori, Gymshark as well, has raised doubts about Lulu, macro pressures for sure, China risk. And these are all the main factors, the main headwinds, all right, that are weighing down the stock. So it's always interesting to take them into account. But this is part of the main things that I wanted to share with you guys. And if we go to our valuation framework right here, we can start playing with some of the numbers. So, for example, we know that management is guiding for is guiding for, they expect diluted earnings per share to be in the range of 12.77 to 12.97 for the year. And so that's the number that I'm entering right here. I'm being very conservative in using that lower the lower range, and then you can see that analysts are expecting earnings per share to grow at about 10%. However, if you look at the company's track record, yeah, you can see that they have grown earnings per share substantially. And so I'm going to up this, okay, because I think analysts have become too negative. I'm going to use 12% over the next 10 years, all right? And what happens is if you double the growth rate, so you take the earnings per share, and then you are going to multiply the earnings per share you're going to multiply the earnings per share by your growth rate, which in our case is going to be at about, well, sorry, you take the current earnings per share, yeah, and then you're going to grow this earnings per share at your expected growth rate over the next 10 years, which is about 12%, and you will end up with an estimated future earnings per share of 39.66, right? So if you multiply that by the future PE, which is going to be double the growth rate, in other words, 22, right? I use 22, but you could use 24. That gives you a future earnings per share. That gives you so a future earnings per share multiplied by future PE of about $872. Yeah. So if we are right, if our assumptions work out well, that means that in 10 years Lululemon is going to have this value right here. All right. Value per share, which is substantially higher from where it's trading right now, and you can see that the intrinsic value, is going to be about 280. How did I do that? Remember that I always want a 15% minimum acceptable rate of return, and if you do that, you just need to divide this, as you can see. Sorry, you just need to then divide 280. Right, you divide that by 4, and you will get to that intrinsic value. So how do I do that? Hold on. Yeah, exactly. So to get to that intrinsic value, as you can see, so you divide the future earnings per share. You divide this number, future earnings per share times future PE, you divide it by 4, and that gives you an intrinsic value of about 218. It means that if you pay this price, that means based on your assumptions, you are going to be able to grow your money at 15% per year. And of course, $218 per share is well above the price that the company is trading right now, which is 160. That goes to show how negative market participants are. Okay, because I mean, and I've been very conservative in my assumptions, if you ask me. So this is our margin of safety calculation. But now, what's interesting is that let's say you want to recoup your investment in 8 years, and let's assume you buy the entire business. Let's not use free cash flow per share because the company is in a growth stage. Let's use earnings. And let's say you want to take your money, if you bought the entire company today, then you want to know how many years it will take you to get your money out of the business from earnings. So let's grow the current net income at our expected growth rate, which is 12% over the next 8 years. And that gives you a cumulative earnings number of 24 billion. If you divide this by the number of outstanding shares, that means the price you could pay is about $203 per share. So if you buy the company at $203 per share, and if the company does manage to grow earnings by at least 12% per year over the next 8 years, you will be able to get your investment back, assuming you are buying the entire company. And that is the payback time. So you can see that payback time gives me $203 per share. The most price, so the margin of safety price is about $110 per share, but this is very conservative if you ask me, because the margin of safety is most suitable for companies that are growing faster at 15% or more per year, which is not the case of Lulu based on our assumptions. And so I would pay more attention to the payback time calculation. All right. But if we now go to our DCF, look at that. If we take current earnings, which is right here, and I think current earnings, let's use this. So it's okay. Let's change this because I was using free cash flow, but it's not really the best metric to use. Okay, so the current price is about 100. What's the current price? 159. 159. They have, okay. And we are assuming the company will grow at 12%. Look at that. The fair price is about $201 per share. So if the company manages to grow earnings at about 12% over the next 10 years, our expected intrinsic value per share is about 201. Now, remember, the net income that I'm using right here is going to come down because the company has issued lower guidance, which is part of the reason why the stock plummeted. However, this gives me an intrinsic value per share of 201, and the stock is currently trading at 159, which is substantially lower. So I think we have a big margin of safety here. And what's more interesting, as I mentioned, is that Lululemon is so much better company compared to its peers, right? And they are going to be able to not only increase some of their to pass on some of those price increases to the customer, but if they didn't want to, they would still be able to come out ahead of competition because they have higher margins. They can absorb those costs. They can absorb those costs, and even when that is done, the margins are still going to be superior, which I love. That goes to show how competitive they are against the main peers. So look, I hope you like this deep dive into Lululemon. And if we go here to our chart, I mean, look at these metrics. Look at the margins, all in the green, right? Look at their valuation ratios that we are using. Everything in the green. Same with the returns on capital. That's crazy. Okay. Granted, capex to operational cash flow is the only red flag. Right now it means capex accounts. Capex is it means that capex is using up about 25% of operational cash flows. So yeah, but this is because the company, remember, is expanding. But ideally, I would want to see this below 15%, as you can see right here, okay, below 15%. So let me know in the comments if you like this video, if you want me to put out more content like this. And this is a company that I think is going to be great. And like I said before, I love how transparent management was during the conference call, and I think the company is going to be well positioned, right? Because they still have a brand moat. And it's not like they don't have pricing power either. They have been able to increase prices because they've mentioned that in the conference call. And that is an important sign of a moat, right? So, yeah, let me know if you liked it, and have a great rest of your Sunday, guys.